Hello and welcome to this special show, Global Jitters, the end of easy money. I'm Prashant Nair. Global stocks, emerging markets, forex, foreign exchange, oil and metals all have fallen today. Asian stocks had their worst day since the Brexit vote, with the MSCI Asia Pacific Index trading 2%. And of course, global markets, other global markets have been in pretty bad shape as well. Let's start with the Indian market per se. What really did happen today? So you have the Sensex and the Nifty, which lost pretty heavily in the Asian market time, along with the rest of the region, which was under pressure. There was risk aversion across the board. The Sensex was down 440 odd points or so. The Nifty was also down about 1.5% by close. So pretty large cuts after the big cut and the big sell-off that we saw in the US market session on Friday. Remember, for a while now, there had been a fair bit of calm. I mean, you could have seen that by looking at the CBOE volatility index in the US, which had been at a low level for a while. But how long could the calm last? Finally, things gave way. So this is essentially what is happening. The basic big fear has been the fear that the Federal Reserve is going to increase rates in September. There are two meetings in a way which are being considered as being live. One is the September meeting, the other is the December meeting. If you purely go by what markets are indicating, markets are telling us that there is only a 30% probability, even after all this market mayhem, that that US Fed will increase rates in the month of September. 60% chance that they will actually increase rates in the month of December. So that's where we stand. But generally speaking, there is also a sense that other central banks like the ECB, which met last Thursday, and in a way which kind of sparked off this entire trend of global markets panicking, Mario Draghi was asked a question whether they will do more, and he replied cryptically, not at this point. We're not thinking of more at this point. And that led to a bit of a spike in bond yields. Global equity markets started selling off. Currency markets started reacting. The dollar strengthened, and that spiral essentially started from there. It showed up in the US markets as well. So is this the start of something beginning, something more, or is this essentially just a small correction in what has been an otherwise absolutely good last so many weeks now? Manish Kabra, Vice President, Equity and Quant Strategy at Bank of America Merrill Lynch, is now joining us on the phone line from London. Thanks very much, sir. Good to have you with us here. So that is my question. Does it look like the start of some big global turmoil, or you think, well, this is just a break that we saw in the market for about 24, 48 hours, and it's going to be okay now? What do you think?
I think with any market rallies, everyone needs to pause for breath after running so hard. So for us, it's as in U.S. market had the calmest period, as you were saying. When we look at it, it's like 42 days of less than 2% move. That's the longest period of calm in 80 years. So as in anything, even a small disappointment is it can create big moves, because a lot of the quant fund CTAs, they start increasing their leverage when there's so much of calm in the market. So we can have wobble, no one will say corrections or short-term corrections are not impossible. But I think the key we have to remember is the long-term investors are not fully involved in stocks. So when we watch cash levels from investors, when we watch allocations to stocks, they are still not at a euphoric level. If anything, they're quite at cycle low levels, which makes us think any corrections would be quite shallow.
All these different Fed governors, Fed officials speaking, and all of them actually at least a few indicating that there is a possibility that September meeting is live. But if you read through, and I did read through what the Fed officials said on Friday, for example, in the US, there are three who are supposed to speak later today. You could kind of use those statements to fit any puzzle that you might be solving. If you want to believe that, well, September is imminent, you can use those statements to support that. Or you can say, well, September hike is out of question. It's only December. How much weightage should we give to these statements which are coming in from different Fed officials? And how much final bearing will these statements really have on the decision itself? Go on.
Well, ultimately, it would be Janet Yellen, as in when she, as in Janet Yellen hasn't really come out and spoken about any hike in September or possibility yet. So there may be few Fed members they will sway with Janet Yellen. As in we'll see how it comes through. At the moment, there's markets not expecting Fed hike in September. When we watch global cycle lead indicators, we are still in very, very early stages of any improvement. So having a big negative shock, as in from the Fed, at this point, it will be taken negatively, at least for a few weeks. So we are seeing whether, as in a lot of the U.S. lead indicators data, they're not at a stage where Fed is really, as in they should really be hiking. So I think the knee-jerk reaction from the market would be negative if they hike in September.
Just one more point, Manish. So this essentially relates to the ECB decision on Thursday. Is the focus now shifting from monetary policy to fiscal policy? And that would explain some of the rise in, the back end of the yield curve? I mean, or is that kind of taking it too far? What do you think?
So I think with the ECB meeting, there was a disappointment. There was a disappointment in terms of when we watch inflation forecast that ECB has, even until 2018, they're well below the 2% target they have. So more and more we are interpreting it's when we read between the lines, it does look like as in they're pausing for breath before they really give out what they have to offer next. So I think there's a bit of a disappointment, but market will realize, as in Europe is one place where monetary policy will be staying for longer. As in we are not expecting any major fiscal package in Europe. We had some fiscal easing last year, but Europe is the last place where we will see fiscal easing. So in that context, dependence on monetary policy is actually going to stay high, especially as in when we are watching economic data, as in Europe would be the laggard in global economy.
Manish, I request you to hold the line. Guy Stear, Head of Emerging Market Strategy at Societe Generale, is also joining us on a phone line right now. Thanks very much, Mr. Stear. Appreciate you joining in. The market panic that we saw on Friday and today as well, at least in the Asian time, and European markets as well. What do you make of it? And do you think we'll continue to see some more turmoil in the coming days?
Well, I think that the real driver for the sell-off that we saw at the end of, as you mentioned yesterday and this morning in Asia, and a little bit in the European session, although I would say Europe is a place we began to turn around in, was mostly due to changes in terms of the expectations of the Fed. I think the Fed has been saying for some time we could raise interest rates, the conditions are in place for us to raise interest rates, and the markets clearly haven't believed them. Now I think there's a little bit of a shift. We're saying, well, maybe they actually are going to do what they've been telling us to do. And I remember that this time last year when they did raise interest rates, we ended up having a little bit of a very weak performance in a couple of months after. So let's get that weak performance out of the way first in case they are going to move in terms of monetary policy. So I think that's the explanation for the way that the markets have traded.
Right. No, so from here, what do you do? I mean, what do you think markets will do rather?
I think the focus should be not so much on monetary policy, but rather on growth. So I think that the really critical thing for the next, let's say, 6 to 8 weeks is what the tone of the U.S. earnings season is. If you look at things like the corporate bond world, we will be very interested to see what's going on in terms of balance sheet leverage, because it's basically been going up all the time. We'll be very interested to see whether the operating cash flow is strong enough to be paying for that balance sheet leverage, and I think that's going to be one of the issues. I think when we talk about emerging markets particularly, they are going to be more sensitive to Fed policy, even though I think that the growth in emerging markets is actually more solid now than it was this time last year. It feels a lot better in many areas. So we start in a better place in terms of emerging markets, even though we have had quite a decent rally over the last 4 to 5 months. But I think there could be a little bit of an exhaustion, so emerging markets could come under a little bit more pressure rather than some of the developed market assets, which should really focus on the ability of U.S. companies to generate money in Q3.
Since you track emerging markets, what's your sense on a market like India, especially portfolio flows, and what may happen to what foreign portfolio investors may do in India as and when the Fed does increase rates? Yeah, go on.
I think that so talking first more broadly in terms of emerging markets, the Fed raises interest rates. People assume that this is going to be a fairly shallow cycle. We're still left with relatively low bond yields compared to what we've known in the past 50-odd years. People are still very keen to get yield, and they'll still buy emerging markets at a hefty yield differential if they think that those emerging market currencies are going to be relatively stable. So it's really a clear question of, is it still attractive to be picking up yield or not? And I think in many areas of the world it is. I think unfortunately Asia is one of the places which offers some of the least attractive yield relative to the U.S. But in Asia, you can build a much better medium-term story in terms of much better economic medium-term management, and that's been very much the Indian story. So India, if it's just about yields and the flow of money, India may underperform a little bit, other more high beta emerging market areas, but in the medium term, it's still a place where there's some interesting opportunities, definitely.
Manish, the same question to you. I mean, the last time we saw that Fed hiking cycle, so I mean, Fed moved from what, 1.5% in 2003 to about 5.2% and 5.25% in 2007. You know, the stock market here went up 6 times during that period. The rupee was pretty steady. I know the context is different now, but in many ways, things are looking good, right? I mean, the current account deficit, for example, here is pretty good. It might even turn into a small balance. We're getting pretty steady FDI flows every month, $3 to $4 billion or so. So my question is, how will India perform both on the equity side and the bond side, fixed income side, in the event the global turmoil deepens?
So I think as you know, as we know, like watching growth or economic indicators would be ever more important. You know, earnings would be the key driver, if anything. But as in if we watch again the growth cycle, and as in for us, it's still in the less bad place scenario rather than outright good scenario. So what we call in our cycle phases, we are in, as in for global, we are probably in early stages of recovery. At the same time, in December last year, we were more in recessionary phases of the cycle, so outright contraction. So if you're looking through in global turmoil, typically Fed doesn't hike when there's second derivative improvement in data. We need right order, like first order of improvement before Fed really moves into a strong hiking cycle. So in this phase, in emerging markets, we are more in favor of high beta commodity countries, cyclical countries in emerging markets than more defensive consumer oriented. So India is not the first place for us to be looking for opportunities, actually, because of its defensiveness, consumer quality.
All right, gentlemen, just hold the line. We also have Peter Hooper, who's Managing Director, Chief Economist with Deutsche Bank, joining us on a phone line from New York. Mr. Hooper, thank you very much for your time, sir. Good to have you with us, with you here with us. Now, as you see it, sir, just put in context the entire volatility and turmoil that we've seen in global markets on Friday and today. What do you make of it, and where from here?
Well, I think a number of factors involved, but certainly increased interest in the possibility of hearing something a little more hawkish from the Fed. Certainly on Friday we had a dovish FOMC member, Eric Rosengren, speak out a little more hawkishly. There is a lot of interest to see whether Lael Brainerd, who speaks here in a couple hours, will follow suit. Certainly it's an opportunity, should the Fed want to raise market expectations, for her to do so. And it's a close call. But my sense is that things will probably ease over here, and then we'll go on to December. But certainly there is considerable interest very near term in the possibility, given what's been a string of fairly upbeat talk from key Fed members about the economy, and in the wake of improving labor market conditions.
Yeah.
Though we have a bit further to go on inflation.
Right. Mr. Hooper, is it all related to what the Fed, I mean, if one kind of scratch the surface, one finds that many out there are not very convinced that this is all to do with the Fed or the ECB or, for example, other central banks. I mean, this is, could this recent turmoil just purely be more technical in that sense? I mean, everyone on the edge over supply and you know, that kind of triggering a bit of yield movement spilling over into onto the equity side, or is this really panic related to what the Fed may do, may not do?
Well, anything's possible here. When you start getting into technical possibilities, I'm certainly not the expert on that. I do know that there had been some heightened interest toward the end of last week, and some reaction to Fed speak and the possibility of, I mean, I'll say that the interest in Lael Brainerd's speech came up when it was announced late in the week. Normally these speeches are announced way in advance. This is sort of a last-minute thing, and could be purely coincidence, but could also be the possibility of the Fed wanting an opportunity to send a little bit of a message. We'll find out soon enough. But as you say, there are other things involved as well, most likely.
Mr. Hooper, do you believe we'll see the Fed hiking in September?
Our call has been for quite some time that we would not see this until December. I would say that my view has been that the probability, the odds have been somewhat higher than the market's been expecting. I still think it's less than 50-50 for September. But the economic case for doing something, given where the labor market has been, given that financial conditions overall had settled down post-Brexit,
right?
The case for doing something, and given the kind of talk we heard from key FOMC members around Jackson Hole, and since then, certainly the possibilities there. But I still think it's more likely to be December at this juncture.
All right, just a quick market-related question to both of you. Mr. Stear, first to you. So this is a shallow correction in your view? Very briefly, sir.
Yes, I mean, I think that's pretty much that's correct. I think that we'll see a recovery fairly soon, and we'll actually have some improvement, I think, into the U.S. Q3 earnings season. So I think that the beginning of October will be good.
Manish, shallow correction?
Yes, yeah, pretty much so. So very much in line there. The recovery paths will depend on growth, but as in Fed hike in September it would be more than a shallow correction, so a bit higher probability of market correction.
If the Fed hikes, right? If
yeah.
All right.
Yeah.
Thank you very much, Manish, Mr. Stear, and Mr. Hooper. Appreciate all of you joining in on this show. Thank you very much for that perspective. Really very useful. Thank you indeed. So that's the market for you. What we'll do is we'll take a very quick commercial break. On the other side, we'll get you more voices. We'll also shine a spotlight on the big deal which has gone through here. So the Cain-Vedanta merger is going to go through. Shareholders of Cain India have voted in favor of merging with Vedanta. Mr. Anil Agarwal, chairman of Vedanta, spoke with us. We're going to get you that as well on the other side.